People get life insurance for a lot of different reasons, but those reasons boil down to something pretty simple. They want the people they love and care about to be taken care of. Problem is, life insurance can be complicated, so let's try to make it a little simpler. There are thousands of different types of policies out there, being sold by hundreds of different companies. Yet all of these policies really fall into one of two categories. They are either short-term in nature or long-term in nature. And there are things I like and don't like about both types of policies, so let me show you how these work, and you decide what type of policy is most suitable for you. First, short-term policies. What we like about short-term policies is they are cheap, initially. You can get a lot of coverage for a little bit of money when you're young. But the downside is, the older you get, the more expensive they become. So before we go any farther, it is very important to ask and answer this question. How long do you want your life insurance to last? Let me show you how they work. Short-term policies are a lot like running stairs. Think back to high school or college. Did you ever have a coach make you run stairs for conditioning? How did it feel when you started? How did it feel when you got to the end? When you're in your 20s, you can get a short-term policy, let's say, for $100,000, for as little as about $10 to $15 a month. However, this same policy in your 30s will cost $30 to $40 a month, and in your 40s, it will cost $100 to $150 a month. In your 50s, it can cost $400 to $500 a month, and in your 60s, $1,500 to $2,000, and so on. Pretty soon it gets so expensive that you cannot afford it any longer, and you cancel the policy. The company keeps the premiums you've paid, and you walk away with nothing. Did you know that only 1.2% of these policies ever pay out? What I don't want to have happen is that you buy one of these policies and then 20 years later, find yourself faced with staggering premiums that you can't afford. This is the downside of a short-term policy. Now, let's look at long-term policies. What we don't like about long-term policies is that they are more expensive initially, but they are the cheapest option out there if you want your policy to last until you die. This is how they work. Long-term policies look a lot like a bucket. How old are you? Do you know when you're going to die? Did you know that the life expectancy of a woman is around age 92 and a man's is around age 90? So if you're, say, 45 and your life expectancy is 90, then the insurance company can expect the likelihood of collecting premiums for the next 45 plus years. The idea is to average the expense of the policy over your entire life so that it is more affordable over the long term. You see, they overcharge you here so they can undercharge you here. Because we are heavily regulated in this industry, the government says that an insurance company has to provide other benefits as well as a death benefit. A long-term policy is a lot like a bucket, a place where you can store cash, like a savings account. Do you know what you earn in a savings account at the bank? Probably about 0.25% to 0.5%. Depending on the type of life policy you select, you can get a bucket savings account that gives you a guaranteed rate or return in the 2% to 4.5% range, with life insurance coming along for the ride. Another bonus is your account compounds your interest like a Roth IRA, tax-free. Let's say you have $150 a month you want to put towards your life insurance. Each month, your contribution goes into the bucket earning interest. A small amount comes out of the bucket to pay for the death benefit, which covers the cost of the insurance. The rest of your money stays in the bucket earning a compound interest return tax-free, waiting for the day you want to withdraw it. So, when all is said and done, you get an account that pays out if you die, and an account that pays you out if you live. Either way, you or your family will get your money and an interest rate return that is tax-free. This is better than what you can get in a savings account at the bank. With these basics in mind, the most important question you should answer is, what can you afford? Can you afford $1,000 a month? $500? What does your budget have room for? Once you know what that number is, we can run calculations on what your policy will look like and how it will grow and work for you, either short-term or long-term.